Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
I wanted to make this point, and really this is a core point. If you ever read the Financial Times, they do a pretty good job in there of covering this whole global rebalancing theme. The global rebalancing theme is this idea that, during the era of free credit, we had overconsumption countries and we had overproduction countries, incredibly imbalanced. It was the idea of the U.S. current account deficit, very huge, and the current account surplus nations, their surpluses never seemed to stop rising. But the credit crunch changed this because it started to change the relative demand. U.S. demand fell off the table, and all of a sudden, countries like China, the current account surplus nations, were starting to get in trouble on their export side. Well, if you look at it on a micro basis, we have the same type of microcosm going on in Europe, where Germany is the major, as I said, exporter country, and it exports its overproduction and overconsumption goes to the rest of the eurozone. All that borrowing of low interest rate money created this overconsumption ability in those fiscal basket case countries. Now they're in trouble. Germany provided all the production to them and created more and more surplus. So the point is, as the eurozone demand falls in a very, very big way, Germany has to look someplace else to take its exports. And as it does, it starts to bump up against China, who's looking for more and more places to have its exports because demand in the U.S. is falling. So this idea of austerity pushing down demand further and further in the eurozone is ultimately going to create some global tension between these two major exporters. And if you've been paying any attention of late, you may have seen the eurozone finally step up, which they haven't done for a while, and become very, very verbal against China just this week on their policies, their trade policies, and they're clamping down on international companies doing business in China. That's no mistake. It's because of this global rebalancing taking place. Germany and China now are looking for places for their exports when demand is falling off the cliff. So these two major exporters are bumping up against one another in a big way. You throw the U.S. in here and you throw Japan in here, and then you say with eurozone consumption falling off the cliff, U.S. consumption falling, and doesn't look like we're going to get anywhere back to the drunken sailor type of buy-in the U.S. consumer did in the past. Japan is in the tank in terms of its demand. This tension is rising, and this eurozone problem of global rebalancing not only reverberates within the eurozone itself, it starts to pressure everybody in the global economy. So when you hear people talk about, well, this is just a eurozone problem, it's not going to impact global growth. Well, disregard that out of hand. It will impact global growth, and it will impact global tensions, and it's already doing it in a very, very big way. Let me make one more point here. We're told that for these countries, Portugal, Spain, Greece, to get out of this problem, they have to have more and more austerity. But the reality is, no matter how much austerity they have, are they going to create the kind of efficiency to allow them to compete against Germany? Now, if they didn't have a common currency, they could devalue their currencies and compete against Germany. But they don't have that option. They're stuck in what we call the straitjacket of the euro. So as long as these countries are stuck with the euro, they're just going to take the domestic adjustment in a very, very painful way, but it doesn't mean they're still going to be able to compete anyway better against Germany. In fact, it'll probably be worse because they'll lose a lot of their productivity from private sector businesses that are a bit vibrant at the moment going out of business. So the austerity measures we don't think are going to solve this problem at all. And the only way, one of the really only way out is going back to their own currencies, devaluing, and then presenting them with a modicum of competitiveness against Germany. Austerity, we just don't think is any way of achieving the wealth creation and the competitive situation that they need to compete against Germany in the zone. I think we've already seen that the $700 billion that they've talked about the rescue package and bringing in the IMF for part of this, is already in question. Bond yields have already, gone back. Spreads have already widened out. Not in Greece because of the backing that Greece has now, the ECB just buying their bonds directly. But in the other countries, the spreads are actually higher than they were when this whole savior of $700 billion was manufactured. And I think the market realizes that $700 billion is a lot of money, $1 trillion. In this day and age, trillion here, trillion there. I know it's getting ridiculous, but if you look at the actual debts in what we call the PIGs collectively, Portugal, Italy, Ireland, Greece, and Spain, when we got these numbers from Lido Research, these aren't ours, but we think they're accurate, and they're probably about 2 months old, sitting on 2.9 trillion or 2,946 billion. That's 2.9 trillion of short-term external debt, and a colossal 8.1 trillion of long-term debt, which means that a couple of things. Number one, $1 trillion, which is a huge amount, isn't going to come close to covering this problem. Number two, the institutions that are holding all this paper are sitting on a lot of paper that day by day is losing more and more value. And if we see one of these countries pull out of the eurozone and all of a sudden move back to their own currencies and devalue 20, 50, 70%, you're going to have major write-downs of all this debt in a very, very big way. And that's why the point is, how safe is the European banking system when you look at these numbers? And I would say it's not only not safe at all, it's just teetering on the abyss, to tell you the truth. And that's really what the panic is here. And when we say we want the euro as a currency to go away, we say that, but we understand the consequences here of the potentiality of a real global conflagration if the European banking system panic spreads and contagion. And let me just add to that. I know it sounds a bit, what the word is, almost trite or sarcastic when we say that, but the reason is we think ultimately if the euro goes away and these countries go back to their own currencies, the currencies can find their own relative value and make these countries more efficient. These countries can then specialize in doing what they've done best, and I think the regulatory environment that's been blanketed over them for Brussels will go away and allow a lot more private sector companies in all of these countries that specialize in doing what they do best, as to be directed by Brussels to a degree, will ultimately be the best thing for Europeans in general. And if we do see once we do see the euro break and go away, if it happens, give it a little bit of time, and we think that's a wonderful time to start buying European stocks, European corporate stocks, and small business stocks in the eurozone. So we see a very, very positive outcome ultimately after the pain if the euro does go away.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.